Welcome everybody. Today we're here to talk about the Perth property market. That's a topic that has got a lot of coverage in the media recently, and from discussions with clients and other people, there's a lot of uncertainty about where we are now and where we're heading. We saw a massive rush into property post the COVID lockdowns of March 2020. And we're at that point now where people are just unsure whether it's going to continue or whether we're going to cool off, or what's the status of the property market. So today we've invited Lachlan Delahunty from Performance Property Advisory, which is a boutique investment advisory firm operating nationally. They have about 70 staff and have done over $3 billion in transactions over the decade that they've been operating. And from personal experience, they've done a really great job with clients that we work with. Lachlan's going to give an update on where the property market is at, both in Perth and nationally, and then we've got time at the end to answer some questions. Over to you, Lachlan.
Thanks, James. I'll jump into our presentation and I'll take you through an economic update. There's a lot of uncertainty in the national markets at the moment, specifically here in Perth. There's a lot of positive sentiment around, but certainly, I guess the question a lot of clients are asking, where are we at in the cycle and how long is this going to last for? So I'll endeavour to do that through the research that's formed from our investment committee, go through a number of data sets to illustrate our view on the market, both on a national standpoint, but also locally here in Perth, as well as give you a bit of an overview of, I suppose, the process involved in investment purchasing, as well as what you should consider when looking for a primary place of residence. So a lot to cover, but I'll endeavour to keep this short and sweet. So from a national standpoint, there's been a positive news story across the board. National home values in June alone were up almost 2%, 1.9% for June, taking the annual growth for 13.5%. So that is significant. For houses, it was 15.6%. So that's the highest national residential growth that we've seen since the early 2000 boom. And I think if we cast our minds back to that period, property prices in Perth alone soared 35% in 1 year alone, being that 2006. So very significant to be back to those sort of levels, with the best performing suburbs being that of Darwin, 21%, and the worst performing being that of Melbourne of 7.7% annually. Understanding that Melbourne was in lockdown for a good portion of that time. So Perth home values have increased 7% for the first 6 months of 2021, up 9.7% from the last 12 months. This has started to taper off, as you can see, 0.2% in June alone. But again, that's quite positive considering Perth is very seasonal in activity. So to see the market still perform during this winter period is that of a positive for the market. So where does that leave us? With Sydney almost back to its 2017 peaks, Melbourne progressing back to the top of the cycle. And as you can see, the views on our other capital cities across Australia and population centres, it's pretty well, the majority of the country is progressing through the cycle. Still very early phase, and again, this is based on the data that we'll go through over the next 20 to 25 minutes. Cairns, Darwin, Perth, Bendigo, still very much at the early phase of the growth cycle. But we'll go through that in more detail. So Perth, there's so much speculation, and it's there is a lot of positive sentiment, which is great. For the first time in a number of years, people are starting to see equity in their property prices. People are interested in property again for the first time in a decade. So it is a good time to be in the market. I suppose for those that are not in the market, it might seem somewhat frustrating not being able to find properties. There's a scarcity of dwellings, which we'll go through in detail as to why. I suppose the good news is, as you can see in the cycle, our belief as a business is that Perth is still very much at the early stages of the cycle. So if you do not have exposure in the market, it's not the end of the world. And we'll go through that in more detail. I suppose the big questions that I get asked is where we're at in terms of the cycle, which we sort of alluded to already, how we got here, and sort of are we in a COVID bubble, and where we're going, and that's looking at the medium to long-term views. So I'll try to depict that over the next period of time through our data and our research to give you a bit of an insight into our view on the market. The first point of call is looking at the supply and demand equation, and I always like to start with the supply side of the situation. And to answer that question of how do we get here, and that question of why there's such a scarcity of properties here in Perth, this is a really good place to start. So at the end of last week, there was 8,933 properties available to buy and 2,800 properties available to rent. So it's a significant reduction from the year before, 23% down for purchases and 49% down for rentals. People start to, I suppose, question as to how this may have occurred. And if we look at the supply side of the equation, you can start to sort of understand this didn't happen overnight. It's been progressing since pretty well 2014. So when we look at dwelling approvals versus population growth, in 2014, there were close to 30,000 new dwelling approvals for that calendar year. And then we fast track, obviously, there's been a significant reduction year on year to 2019, where there's only 16,000 dwelling approvals. So that's almost 60% down from 2014. And again, in 2020, there was an increase, almost 16,000 dwelling approvals for the year. And understand there was a stimulus package put in place to encourage this. That's still 50% down from the 2014 building boom. So again, when we look at supply, there's been a significant reduction. And when we fast forward and have a look on the demand side of the equation in population growth, this has been on the rise since pretty well 2015. We bottomed out in terms of population growth. Perth currently trending at 1.79%, which is 20% above the national average. When we look at the population movement type, a lot of this activity has been driven by interstate migration. So the problem was in the downturn, in the midst of the building boom, we were losing anywhere from 10 to 15,000 people to interstate migration. So as you can see here, from 14 through to 18, there's significant decline in interstate migration. And the problem is we're building far too many houses that the population required. And when you look at population in general, it's what impacts property more than anything is interstate and overseas migrations, because there's an instant demand for housing. Natural births obviously don't sort of progress until children start to move out of home and stay within the state. But losing that sort of migration, seen a significant rise in vacancy rates, which we'll go into, but that soared to 7.5%, and there was no demand within the market. Fast track to 2019 and 2020, we've had the first positive surplus of interstate migration. And a lot of that's to do with employment. Job vacancy here in Perth have encouraged wage growth. And we're starting to see, even with COVID restrictions in place, interstate migration numbers return back to WA. And the push from McGowan government, I should say, to localise FIFO workers, again, is going to keep, people local, dollars spent in WA, but instant housing pressure. These people need to either purchase or rent a home in a market that's already scarce in that space. Another really good metric to look at demand in the market is days on market. Obviously, we look at this from a suburb level to track demand in local suburb to suburb, but also in comparison to how East Coast suburbs and cities are performing. So when looking at the average days on market in Perth, typically we run somewhere between 40 to 50 days on market. Looking at the better times, 2007, this got to as low as 40 days. But when we fast track to 20, and here in June 2021, that's now down to 15 days. So you can see instant demand in the market, well below our long-term average. Another really good metric to look at instant demand in the market, and we can compare this obviously nationally, and we can sort of compare to how the market's performed also over the long term. It looks at the REWA, so realestate.com, weekly demand insights into buyer activity. So this tracks highly engaged buyer activity on that platform, realestate.com. It formulates an average. So we're looking here at the average, weekly average insights compared to 2019 and where the markets have performed from this point in time. So as you can see, pretty well since the start of 2020, there's been a 60 to 70% increase in buyer activity, and that's remained really consistent until the last week in June. Obviously, the dip in activity there is due to the holiday period, so this is over the Christmas period. But you take that out, we've had pretty well a consistent rise in activity. And you compare this to other states, you look here at Sydney, you can start to see pretty well from the start of the year, there's been a noticeable dip in activity. So this is buyer activity. And we're starting to see those markets, particularly Melbourne, Sydney, Tasmania is another one that's had a significant decrease in activity, about 20% decline in activity from the peaks in January through to June. But looking at Perth specifically, we've remained really consistent. So when I get asked that question of what's the forecast during this winter period, buyer activity remains really strong, still 60% above the 2019 average. So this gives me confidence that the market will not dip in the short to medium term. Again, this isn't, I suppose, an instant insight. This is not a good insight for the long-term view. But certainly looking over the next 6 month period, this would indicate that the buying demand and buying activity in the market is still relatively strong here in WA. Looking here at vacancy rates and looking at the supply and demand equation, you can see it's a pretty telling story of the Perth market. I think when you look at vacancy rates soaring to 5.7% in 2017 on the back of the building boom of 14. Understand during that year, this is a calendar year average, vacancy rates actually got to as high as 7.4%, which is significant. And one of the reasons we weren't purchasing in Perth at this period of time, when you've got a vacancy rate such as this, combined with negative interstate migration, certainly not a market that we wanted to be investing. But fast track to 2021, where vacancy rates have dramatically reduced to 0.9%. It's probably merit as to the story of scarcity amongst rentals, but also properties available here in WA. And I don't see a quick solution to answer this problem, because it does take a pretty significant period of time to bring on accommodation. The quickest way to do it is that of mass supply. But with such a shortage of labour, skilled labourers and shortage of resources, I don't see this solution being solved quickly. So that's an interesting one to watch. But again, in terms of prices and Perth prices, this again is putting pressure on the market, both for rental increases and median house prices. Affordability is another key pillar that we track across all capital cities of Australia, but for Perth, it's certainly been a prominent story for the last decade. I think when you have a 13-year stagnation period or a decline period in values, affordability is probably the only pillar that you can lean towards when looking at any positives in the market. I think it's been well publicised that Perth is one of the most affordable capital cities currently in Australia, with the exception of Darwin. But when you compare to how affordable we are in comparison to where we've been in previous cycles, it is pretty compelling. Looking at the price to income ratio in Perth currently, we're at 5.2 times. That's for houses. So when you compare that back to the peaks of 2004, 2005, when we got up to 7.5 times, we are far from that. We're sort of back to where we were in 2001, 2002. To give you a good comparison, we use Sydney as a benchmark, currently at 10.4 times, and that's discounting the last 6 months of growth. So it's very foreseeable this figure is actually now substantially higher than that. So that's starting to get back to where they were in 2016 and 2017, where that market capped out and with reason. It hadn't been, it's sort of unprecedented, I hate that term, in the current landscape, but it was certainly for Sydney an unprecedented height in the market, and they're starting to trend back to these all-time highs. When we look at the Perth Affordability Index, this looks at the average wage consumed by the average mortgage. And here with Perth, we're at 21%. So 21% of the average wage in Perth is consumed by the average mortgage. Obviously, factors that can take into consideration are interest rates, median house prices, and income. So you look at this and compare it back in time, we're back to sort of where we were in the late 90s, pre the early 2000 property boom. So in comparison to where we are over the test of time, it's certainly a strong case to be made here. But again, using Sydney as the benchmark, fast forwarding, you can see it's pretty significant when in Sydney in 2017, 60% of the average wage in that market was consumed by the average mortgage. So for us as a business, buying properties in Sydney, we took a strong position between 2008 and 2013, 2014, obviously held properties during this period. But in 2017, for the first time, we made a sell rating on Sydney, because at that level, it was clear to us as a business that the market was certainly at its peak. And at those levels, when 60% of the average wage is going to your mortgage, it doesn't leave a lot left for living, let alone lifestyle uses. So, it's a pretty significant stat when you compare to where we are and where capital cities can get to. So looking at Perth, we're very much at the floor of our affordability index, noting that our ceiling previously was at 57%. So as we see markets start to increase, and a good analogy is Cottesloe, as it continues to increase in value and we see auction prices continue to rise, the question I often get asked is, where is the ceiling? Are we at the peak as this market ran? Well, even a market such as that may be up somewhere between 20 and 25% in comparison to where we've been. We're still very early days in terms of affordability onto where these markets have been and where they can get to. Confidence is a big one, and it's really what hindered the Perth market, particularly in 18, 19, and even parts of 2020. Confidence in the market had been lacking for a significant amount of time, and that really, it can cripple or heighten the market quite significantly. When we look at confidence in Sydney in 2017, FOMO really drove that market for the last 12 to 24 month period, where the same was true during the absolute floor of 2017 of the Perth cycle, when confidence was certainly lacking and was almost non-existent within the market. But when we fast track to where we are today, things have certainly changed and the landscape is different. And obviously job creation forms part of this equation. So when we look at where we are today in 2021, June of 2021, we've got unemployment the lowest in the country, and we've got job vacancies, March and April, 23% increases month on month, which is the highest across the country. So in terms of job vacancies and job creation, we're leading the country, which is 110% above where we were 12 months ago. So obviously jobs, employment creates confidence within the market, and where we're heading and where we currently are, this is certainly a stronger data set than where we've been in the previous cycles. Same is true when we look at lending data. So this looks at July last year, so pretty well where we're at 12 months ago. And what's interesting here is the correlation between median house prices and owner-occupier debt. So if we look solely at that, just ignore the investment debt for the time being. But you can see the equation, as you can see, from 2012 through to 2014, there was a significant increase in owner-occupied debt here in WA. And you'll see the correlation, it's about a 6 to 12 month lag in median house prices. But what you can see in this data set particularly is, as owner-occupied debt increased over that period, median house prices with a 12-month lag continued to rise and outperform for the next 12-month period. But the same was true as the market started to stagnate. We've seen owner-occupier lending come off quite significantly from 2012 right through pretty well to 2019, to the start of 2020. And then we start to see that 12-month delay in house prices and median house prices come off quite significantly, particularly to the back end there of 2018, 2019. Fast track to 2021, or the beginning of 2021, you've seen a significant increase in owner-occupier lending. So you compare this back to where we were in 2011 through to 14, this sort of hike in activity is significant. And I don't think you need to be an economist to predict what was going to happen in the early parts of 2021. And as we can see, we've started to see the median house price the early phases of the median house price start to catch up to that owner-occupier activity. So this is where we're at in March 2021. And for the first time in pretty well 7 years, we're starting to see increased investment appetite and investment lending. So what's really interesting is the fact that, realistically, the markets that we've been competing with is really driven by owner-occupier activity. We haven't seen a lot of investment outside our business. We've found, particularly competing in home opens and at auction, a lot of it has been owner-occupier activity. We haven't seen an abundance of investors in the market to date, but forecasting forward over the next 12 months as yields continue to rise, and we've already started to see, certainly increased inquiries into this space, but we'll start to see investors competing with owner-occupiers, and that's local, interstate, and potentially overseas investors as the market continues to progress. The last pillar is investment value, and I guess similar to that of affordability, investment value has been in the Perth market for a period of time. You look back at our long-term growth rates since the 1978, we've been tracking at 6.74% over the long term. So that's even with the last 13 years of stagnation, which is really competitive to that of Sydney and Melbourne. They track between 7 and 8%, so not too dissimilar over the longer term period. But what's promising, or what we've highlighted as significant upside for the Perth market, is the fact that we have been running at 0.3% over the last 10 years. So really underperforming. And you look at the 5-year growth rates, we've been significantly underperforming. So even if the Perth market is to return to the long-term compounding growth rate of 6.74% over the next 5 to 7 years, we're going to see significant upside in the market. When I talked about investors starting to enter the market, you can start to see why. When yields are north of 4%, you really do start to see investors back into the market. And when you're looking at property prices in Sydney, Melbourne, even Brisbane, yields are really compressed, and we're starting to see yield compression sub 3%. So in Sydney, Melbourne, a lot of investors are buying sub 2.5%. When we look at Perth specifically, we're currently buying at the moment, and we're talking long-term compounding growth assets, so strong land value ratios, somewhere between 3.5% and 4.2%. So from that point of view, there's certainly attractive for investors in the market. And when you look at interest rates at the moment and where they're at, and where the cash rates are, it certainly makes a strong point when looking at investment property as a vehicle for wealth accumulation. In summary, obviously there's a lot to like about the future outlook for the Perth property market, be that the medium to long-term view. I certainly am not forecasting significant growth in the short term. When I say significant, getting back to 2 to 3% growth per month was overinflated. That was a February and March activity, and that sort of growth is probably not sustainable. But where we're at the moment, 0.5% to 1% growth per month is relatively consistent to where I think we'll progress to over the next 3 to 5 years. And looking through the fundamentals of the Perth property market, you can see here I've touched on different segments, be that supply, demand, affordability, confidence, money supply, and investment value. Obviously, there is some inherent risks in the market. It's certainly not a perfect market, but there is definitely some upside and some future scope, we believe, in the Perth cycle. So again, our assessment on the market is that Perth is certainly early phases in its current cycle, but like anything, there is markets within markets. Always invest with caution, speak to your advisor before you go out there and purchase a property.